Good morning. I'm Joanne Jobin with VID Media, and welcome to another Arizona Sonoran Copper Company Town Hall Forum. We're here this morning with CEO George Ogilvie and with Anthony Bottrill, who's the resource geologist, who will update you on the company's strategic milestones and work programs related to the Parks Salyer Project and the Cactus Mine Project, including yesterday's news release announcing an updated mineral resource estimate for the Cactus Project. And now, a few words about the company. ASCU's principal objectives are the identification, acquisition, exploration, development, and sustainable production of base metals properties in regions with low geopolitical risk. Their principal asset is the 100% owned Cactus Project, located in Arizona, approximately 70 kilometers south of the Phoenix International Airport. Now, before we get started, I do want to remind you that if you have any questions for the company, please place them into the Q&A tab at the top, located near your chat sections. We will answer as many questions as we can at the end of the presentation. And now I'd like to turn it over to George. Mr. Ogilvie.
Thank you, Joanne, and thank you everybody for joining us here this morning. Obviously, it's Arizona Sonoran Copper Company, and our title of our presentation is the Cactus Project, the Mineral Resource Update. Thank you, Alison. We do make some forward-looking statements, so draw your attention to the cautionary language. This presentation is on our website, so please review that language at your own discretion. As everyone knows, it's a high-quality project. It's located in Arizona, which is a Tier 1 jurisdiction, very low geopolitical risk, and of course, it's a large copper porphyry system. We will be looking at a heap leach operation with an SX-EW plant, so we would expect the capital intensity to be relatively low. And of course, we benefit from some brownfield infrastructure already at the site. And importantly, we have water rights to the year 2070, and including the surface and mineral rights. Since acquiring the project in late 2019, we've seen the resource grow from 224 million pounds of copper contained in a surface stockpile to yesterday's numbers, which were approaching 7.4 billion pounds of copper in all categories. We still believe there's lots of exploration upside, as Anthony will show us in today's presentation. And of course, none of the plans within the PEA that we put out 2.5 years ago, or the PFS that will come out in the first quarter of next year, none of those plans will have any primary sulfide included in them. So if the Newton technology were successful and we can negotiate a fair and reasonable commercial agreement with Rio Tinto, there's the optionality of bringing in the primary sulfide as well. Importantly, you also have a management team here with a proven track record of delivering exceptional results for the shareholders of the company. And of course, we take our environmental and social responsibilities extremely seriously. We work very closely with the local community and a very, very strong social license. And you'll hear more towards the end of next year concerning our ESG strategy, and certainly believe that this mine will be a low carbon emitter. Thank you, Alison. So a little bit on the location of the project. Obviously, the project's located 45 miles south of Phoenix. Phoenix, as everyone knows, has a population of over 3 million people, including the greater area. We're about 75 miles north of Tucson. And of course, Interstate 10 is only 10 miles to the northeast of the project. On our southern border, we have the Maricopa-Casa Grande Highway, and we also have the Union Pacific Railway line. So the project benefits from significant infrastructure already there. The main power line runs right through the property, and we have the ability to draw 100% green energy from that line. And you'll also notice that in the immediate area, we have some former and soon to be producing mines. Obviously, the closest I would suspect in the next couple of years will be the Florence mine, which is obviously owned and operated by Taseko. Thank you, Alison. So on to the mineral resource update, and I'll hand over to Anthony.
Thanks, George. So what I wanted to highlight on this slide with the waterfall chart is actually what the focus of the recent resource has been. So from our previous PEA resources to the resources we've just released, we've really focused on infill drilling. So you can see the large conversion there of our inferred resources into the indicated, which has been really successful for us. There has been, in addition to that, some increases to the indicated, and that largely related to the some successful infill drilling on Park Salyer. So if we just go to the next slide, Alison. This is more detail around the resource, and there's really a couple of things to highlight here. If we look at the total M&I, our project is really about the PFS, and the PFS requires measured and indicated resources. So in the total M&I, we've been able to move that up 220% from 1.6 billion pounds up to 5.1 billion pounds. But in terms of the PFS, where we're just focusing on the leachable, so the oxide and the enriched, we've been able to move it from just over 1 billion pounds to 4.4 billion pounds. So a 316% increase. And one of the success stories of that was the Cactus East and Park Salyer, where we've been able to maintain those high grades above 1% total soluble copper. So to support what we're talking about here in the resource, I'm actually going to take us into 3D and have a bit of a look at the data spatially. And so these were the resources as of the PEA. We have the Cactus deposits here. In the upper right, we have Cactus East and then Cactus West. And then we also have the stockpile, which I'm not showing the resources, but that's the stockpile area on the air photo there. And then down here in the southwest, we have Park Salyer. The orange colour that you see there are our inferred resources, and the red colour is our indicated resources. So at this stage with the PEA, we had 25% of our resources in the indicated category and 75% of our resources in the inferred category. So going into the PEA in 2021, we had Cactus and the stockpile. When we reported the resources, we actually generated a conceptual pit shell, and that pit shell was related to both oxide or driven by oxide, enriched and primary material. And so you can see that in that resource shell, Cactus West and also part of Cactus East were mined with an open pit. So that's just on the resource reporting. We then had a small amount of underground reported material that sat outside of that pit shell. When we came to the PEA itself, that was just based on the leachable material, so the oxide and enriched. And what we found when we actually ran the PEA was that it made more sense for us to actually mine Cactus East, the high-grade material, as an underground, and mine Cactus West as an open pit. And so if I just rotate that around, you can see an underground being developed there in Cactus East, and then the Cactus West open pit. So in late 2021 and into 2022, we embarked on a big infill drill program around infill drilling this pit for Cactus West and the underground for Cactus East, and then also the stockpile for bringing that into indicated. So that was to move that material into indicated and measured so that we could look at a PFS on it. Towards the end of those programs, we got the opportunity to do some exploration on Park Salyer. To the south of Park Salyer is a property called Mainspring. We knew of some historical holes that have been drilled on Mainspring. We also knew of 2 holes just on the southern end of our property that showed good potential for porphyry copper mineralisation, and they were drilled by ASCU in the 1990s, and their interpretation was that the better grade mineralisation was potentially to the north, and we fully agreed with that interpretation. So in 2022, we actually got the opportunity to embark on an exploration program into Park Salyer. As we drilled north, we rapidly got successful results, and that very quickly turned into a resource development program. And so what we did was we actually drilled out an inferred resource, an initial inferred resource on Park Salyer. Two things to note are we had to carve out this little area here, the MEP area, and we also we didn't have control of mainspring, so we had to cut off our resource along that boundary line. And so late last year, we actually reported a resource, an initial inferred resource on Park Salyer. That was included in an updated PEA. However, it was only included as a resource. And so the economics of the PEA was still based on just the stockpile and Cactus East and Cactus West. And Park Salyer was just included as a resource. And so if I swap over to today, so late 2022 to early 2023, we actually embarked on a significant infill drill program to bring Park Salyer, or the bulk of Park Salyer, into the indicated classification, so that could be brought in line with the PFS. So if I just quickly load on the actual resources as we see them today. If you remember, we focused on infill drilling on Cactus East. We focused on infill drilling of the pit in Cactus West. We infill drilled on the stockpile, and we also infill drilled on a large portion of Park Salyer. And that was very successful for us, as we saw in that waterfall chart and in our recent resource reporting. And so what we've been able to do is actually move a significant amount of our inferred material into indicated. So that's the red material is indicated. We also drilled a small area on what we call the South Mine area of the Cactus West deposit, and we moved that material into measured through further infill drilling. And so for the Cactus resource that we've just released, we now have 70% of our resources actually sitting in measured and indicated, and only 30% sitting in inferred. What we found was, if I load on the resource pit shell, Cactus did not change materially. We saw a very similar resource pit shell and similar amount of material that was sitting outside of that in the underground. What we did find with this infill drilling in Park Salyer is that we found some thicker and higher grade sections. And so we actually saw more tons come into the indicated resource than what we're expecting from the inferred. And so as we step forward now to the PFS that's due in the first quarter of 2024, I just want to load on the material that can go into that PFS, because that's a subset of the resources that we're looking at here. So the PFS, like the PEA, is just based on the oxide and enriched material, so the leachable, and just based on the M&I material. So this is the material that can go into the PFS. If I start with the Cactus West pit, you can see that we've drilled out the material within that Cactus West pit and just outside of it. One thing to note with the Cactus West pit is that in the base of that pit, we will see a significant amount of primary material in the bottom of that pit, seeing as it's currently just a leachable project. So it ends in a significant amount of primary material. If we swing around and have a look at Cactus East, the resource there has about, above underground cutoff grades, has about 41 million tonnes at 1.05, 7% total soluble copper grades. So that has grown. And if I compare that to Park Salyer, Park Salyer has similar grades in about 1.02% total soluble grades, but it has 3 times the tonnes. So where this has 41 million tonnes, Park Salyer has 130 million tonnes. So it's significantly larger. And so these are the core areas that can go into the PFS, as well as our infill drilling that we did on the stockpile. So while the engineers are working on that, obviously in geology, we want to continue growing the resource. So some things that are enabling us to do that, we're now able to report in this MEP area. We're able to clean that area up. We also now have access to the mainspring property. And so we've been able to bring our resource slightly onto the mainspring property, but we plan to expand our resources from Park Salyer onto mainspring. What we see with the Cactus deposits is that there's this northeast-southwest mine trend to higher grade mineralisation. We actually see higher grade primary material in that orientation. And with enrichment, that can be upgraded significantly to, your 1% plus sort of copper grades. So following that trend to the south, we're hoping to see further high-grade underground resources be defined. But the other thing that we're looking at Park Salyer is, if I just rotate this around and look towards the west, if we look at the north end there, you can see the depth to the mineralisation. As we come back to the south, to the edge of our M&I resources and then extend onto the mainspring property, you can see that it's shallowing. And we know from some of the historical holes that have been drilled through mainspring that the mineralisation gets significantly shallower. So we're hoping to define some shallower resources on that mainspring property. When it comes to the Cactus West pit and Cactus East, we see potential in the southwest corner to continue extending resources, and particularly on the primary side of it, where we get quite thick primary mineralisation. And also on the northern sides of both deposits, there's still some room to grow. The other area that there's exploration potential is these gaps in between the existing resources. So these represent horst blocks. We know that there's another horst block in this northeast corner called the Northeast Extension. We actually drilled one hole in there, I believe it was last year, that we reported on, and we know of a handful of historical wide-spaced holes throughout that area. So we'll be hoping to do some exploration on there. And also through this gap zone, along that mine trend, we're hoping to find some pockets of mineralisation. So as we go into 2024, in addition to the infill programs that will continue on from the PFS towards a feasibility study, so trying to bring more measured material in, we're also looking to continue to expand the resources. So George, I'll just pass it back to you there.
Yeah, thank you, Anthony. Greatly appreciate that. So if we move on to the next slide and we focus in on development assets today in the US. With this resource upgrade, and of course we're sitting now in all categories at 7.4 billion pounds of copper, that significantly moves the company up, and we believe that we would be sitting at in and around number 6 out of the top 10 development assets today in the US. The other thing to note there is that obviously with our M&I grades approaching 0.6%, it certainly makes this one of the higher grade deposits. And as Anthony sort of alluded to, that if you take out the surface stockpile and the Cactus West open pit, and we're just to focus in on the underground assets, the in situ grades are actually over 1% T-sol, which would obviously put us right up there with the Santa Cruz deposit. Thank you, Alison. So onto the PFS. Obviously, the PFS is about 90% complete at this juncture in time. We're on track to deliver that PFS early in the first quarter of 2024. And the direction and guidelines that have been given to the project team and the consultants are to look at a mine that would produce between 45 and 50,000 tons of cathode production on an annual basis, with a mine life between 25 and 30 years. And if you think about that, and let's work back from that, 50,000 tons of cathode production a year is the same as 100 million pounds of copper. And if we work with 25 years and multiply those two, we'd be sitting at around 2.5 billion pounds of copper, which would actually be produced. Of course, if you work back from that with a 80% metallurgical recovery, that would mean that there would be approximately 3.1 billion pounds of copper that would go on to the heap leach pads. And then if you work back from that at a 10% loss with mining, you'd be looking at around 3.5 billion pounds of copper actually physically being mined. And we know that you don't see 100% conversion of, resources to reserves. So it's somewhere between 70 to 80% with a base of 4.4 million. We definitely have an opportunity within the PFS based on this resource update and 4.4 billion pounds of leachable copper, certainly to be in the realm of achieving 45 to 50,000 tons with a mine life in excess of 25 years. So I believe when that information comes out early next year, it'll be quite transformational with the company, because on a valuation perspective, it means that the company should be valued significantly higher than where we are today. Thanks, Alison. If we compare ourselves to some of our immediate peers, and obviously I think Ivanhoe Electric and Santa Cruz immediately south of us, and probably Marimaca are probably the two most relevant ones. You can see as far as jurisdiction is concerned, obviously Arizona is a great jurisdiction. You can see now the measured and indicated category is very much in line with Ivanhoe Electric and well above Marimaca. The same on the inferred resource. The 18 years we're showing there is obviously the PEA, but we expect that to grow to 25 years plus. And at 45 to 50,000 tons, as I said, that would be 90 to 100 million pounds of copper production. We also expect the C1 cash cost to remain relatively low, given this is a heap leach, and we benefit from all of the infrastructure that we touched on earlier. We also believe that the capital intensity will be very low compared to our peer groups, again, because we benefit from the location and the infrastructure that's already there. We have increased, obviously, the copper price for the MRE over and above what we saw in the PEA 2.5 years ago. And I suspect when we do the financial and economic model, we'll probably be looking at a $3.75 or $3.80, which is the consensus long-term price from approximately 40 of the banks that cover the copper sector. So, I think the numbers that we're using to calculate the resource and eventually the reserves are definitely in the right realm. If we now go on to the top 10 producers today in the US, if we were able to achieve that 45 to 50,000 tons of cathode on an annual basis, essentially that would put us in number 7 spot as far as tons of cathode on an annual basis. If we were able to see C1 cash costs around $2 a pound, that would probably put us in and around the average of the top 10 producers. And if we look at the bottom slide that we see there, obviously with the grades in and around 0.4 to 0.5, with our T-sol grade, both underground at over 1%, and then overall the total copper grade around 0.58%, that would certainly put us as one of the highest grade producing mines in the US today. And you'll see information that'll come out before the end of the year with respect to our recoveries. We've pulled down the final columns. We're just waiting on the final tails assays, but everything is pretty much in line with what we've already reported, which would mean that the oxides are seeing recoveries of around 90%. And for the enriched material, we're looking at recoveries between the high 70% to the low 80%, which, as you can see there, is very much in line with the current top 10 producers in the US. So just to summarize, we've obviously issued the resource update, so that's a big check mark for the project team. We're on track to deliver the pre-feasibility in the first quarter of next year. Based on our current go-it-alone plan, our intention is to immediately move into a bankable feasibility study, and we would anticipate that by the end of 2024, we would have that bankable feasibility study completed. As everybody knows, the Cactus Project, which consists of the surface stockpile, Cactus West and Cactus East, is currently fully permitted. Of course, those permits do not include Park Salyer. So with the pre-feasibility study completed early next year, we're already making out the applications for amendments to those permits. Those applications will go in late this year, and we would anticipate by the third quarter of next year that we would have the amended permits inclusive of Park Salyer in our hands. Assuming myself and the CFO can organize project financing, once we announce the bankable feasibility study, we would also be announcing a fully funded project at that juncture in time. And currently we're showing an 18 to 24 month construction and development period, which would mean first copper cathode would be realized before the end of 2026. And obviously already having an open pit that has seen development in the past and having an 80 million ton stockpile of material already sitting there waiting to be moved onto the first heap leaching pad as soon as it's constructed allows us to move this project forward at a very high pace. So just to summarize and recap, it's a brownfield site. We're in a tier 1 jurisdiction, obviously low capital intensity with a heap leach SXEW. Remember, we're on private land. There's no federal nexus. So when it comes to permitting, it's a very simplified, well understood process. Since acquiring the project 3 years ago, we've built some scale and size to the project. We expect that to continue as we continue to explore on the property. You have an experienced management team here that's got a proven track record of delivering exceptional results for the shareholders of previous companies. And obviously we have a very strong social license within the community, and our ESG strategy is going to be absolutely critical as we move forward with the project. So with that concludes the formal part of the presentation. And Joanne, I'm happy to hand back to you and open up the floor.
Thank you so much, George. Timing indeed. Great, fantastic update. You've got some very happy shareholders, I'm sure, and some very interested ones because we have a full house of participants in the room today. So well done, everyone, and thanks for tuning in. So now we'll take our questions from the audience. Again, just a reminder for everyone to place the Q&A in the tab located at the top near the chat section. And the first question for today is, George, can you tell us something about the variability analysis for the different zones and their coefficient of variation, please? And thanks.
Well, I'm going to hand over that question to Anthony, given that's a geostatistical question.
Yeah, thanks, George. So the CVs on the deposit are quite low, particularly when it comes to the primary. The CVs are well lower than 1. I forget the number offhand, but probably around 0.7 or so. As you get higher grade, we do see higher variability. And so in the enriched, we do see a higher CV, but it's still only sitting around the 1 mark. And then as we go into the oxide, which gets probably the most variable of all of the material types, then we get into the maybe 1.5 as the upper side of it. So in general, the CVs are quite low and certainly quite manageable on the estimation front.
Thank you, Anthony. Next question is, please explain how a conversion exceeds 100% from inferred category. It was 221%, and for leachable ore, it was 316%.
Anthony, I'll let you take that one again.
Yeah, so so in terms of the conversion, when we look at the conversion there, you can see that we actually took material out of one category and put it into another. So the 2.6 billion pounds of inferred was actually moved across into the indicated, and so that's actually where the bulk of that conversion is actually occurring, is in that change there. And then on top of that, we actually had some increase in the metal content, particularly at Park Salyer. So at Park Salyer, we actually found an increase in the metal content as we infill drilled. We got better drilling than what the inferred had indicated to us.
Thank you, Anthony. George, can you comment on any potential M&A? I mean, you have some pretty impressive neighbors over there.
Yeah, I think at this juncture in time, the company is really focused in on its, go-to-loan plan and just delivering, value for the shareholders of the company through the PFS and then a bankable feasibility study. I mean, certainly within the region, I would say that there are opportunities for, regional synergies, but I think those opportunities are further down the line when the company's a little bit more advanced and has a much more valuation reflective of, the true entity. At the moment, I would say we're very, very undervalued, and really M&A isn't on the cards at this juncture in time.
Thank you, George. Next question. At 45 to 50 KTPA of copper, the resource supports a much longer mine life than I believe the PEA or the PFS. What are your constraints when deciding how long of a mine life you'll eventually decide on?
Well, look, I think once you get over sort of a 20-year mine life, it becomes less critical. Really, we're focused in on trying to maximize the NPV and the IRR of the project, and that usually comes through, production in the mine's first 5 to 10 years. So we're trying to make that part of the plan as robust as possible, and then ensure that we build the infrastructure to support that plan. But once you get over 20 years, it's not so much of an issue, because at the end of the day, historically mines always have exploration success, and initially when you might start out with a 20 to 25-year mine life, that's going to get pushed out easily by another 10 to 15 years through exploration success. So it's all really about maximizing the IRR, NPV, and ensuring that the project is financeable. And, when you get into project financing and you look at the debt component, usually you'd be looking at a 5 to 6 year tenure on the debt. And that's why you want to make sure that the first 10 years of the mine are very robust.
Okay, and we're getting questions here about the Newton technology assessment. So, people want to know about the milestones and when you could expect to reach a commercial agreement with Rio Tinto.
Well, first and foremost, I've got to say that, we won't require the Newton technology to have a very robust mine here that'll generate significant returns for the shareholders of the company. The Newton technology, as we pointed out in the presentation, is really all just pure optionality. But going forward, what we would envisage there is at the end of the year, the columns that are currently under solution leaching would be pulled down. We would announce those final results in the phase 1 testing to the market. And we're currently in discussions with Rio Tinto about what the phase 2 testing would actually look like. And that phase 2 testing would be rigorous enough that at some future juncture, that could actually be included in further technical reports at a PFS and or bankable feasibility study level. The other thing to bear in mind, and Anthony sort of touched on this, is that at the bottom of the open pit today, we have about 1 billion pounds of copper in primary sulfide. But at the moment, that resource is only drilled out to an inferred category. So again, that would ultimately have to be drilled out into the indicated and then the measured category if it were eventually to be included in a future PFS and or bankable feasibility study. So there's still a lot of work to be done with respect to Newton as we de-risk the technology and get it up to a quality and standard that could be actually then incorporated into, superior technical reports.
Thank you, George. So next question has to do with costs. And do you anticipate any costs creeping up due to the inflation from, for example, from PES to PFS, or will it be a case of oranges to apples in comparison regarding the production scope?
Yeah, well, obviously with an increased production profile, we are expecting the CapEx costs to increase. And as I've said before, with the PEA, we never included a two-stage crushing plant. There was no agglomeration in that plan, and there were no stackers and conveyors. It was driving essentially run-of-mine ore and putting it onto the leaching pad. And of course, since going into detailed metallurgical work for the PFS, which has been ongoing now for well over 2 years, we've come to realize that 1 inch minus material passing 80%, 3/4 inch minus material is the optimum size required in order to see, maximize recovery. So for the PFS, we're going to see additional fixed assets coming in, namely crushing plant, stackers and conveyors, and drum agglomeration. So that will push up the PFS, the CapEx. And then, of course, that PEA was did 2.5 years ago, so it's stale. And we would expect the obviously with today's inflationary pressures, there will be further CapEx that will come in. But I would also like to say as well that at the end of the day, when the CapEx number eventually comes out in this PFS, it's still going to be extremely low when compared to a lot of our peers because of where the project is situated, and it benefits from all of that infrastructure that's already in place. So from a capital intensity perspective, this is going to be relatively low and therefore easily financeable by the company itself, with obviously approaching, commercial banks and various potential debt lenders.
Okay, and so as we're on the topic of financing, what do you think the additional funding will look like to take you to PEA in 2024?
Well, we've always said that we would try and build the project for sub $400 million US dollars. And certainly, if you look at that on a capital intensity basis, it's going to be $8,000 to $10,000 a ton based on the production profile that we just put forward here this morning. And, we want to try and keep that CapEx relatively low, as I indicated earlier, that we want to really control our own destiny and have the ability to finance this project ourselves if so desired. I don't ultimately know what the debt to equity split is going to be, but if you worked on a 50-50 basis, we certainly believe that if the company was looking to raise 200 million US dollars in debt with a 5 to 6 year tenure, but then having a 25 plus year mine life and therefore a 20-year tail, that would be very attractive for a lot of the debt lenders out there, because obviously they would be guaranteed that they're going to get a return on their investment. And that's why we're trying to target something that's sub 400 million US dollars with this production profile.
And just out of curiosity, would that also include royalties if that worked within your financing parameters?
Yeah, obviously we're putting together the financial and economic model as we speak. We're factoring in the royalties that we currently have on the project. Obviously, the company has the ability to buy back a portion of those royalties. And we haven't got to a stage yet where we have determined whether or not it's accretive to actually buy the royalties back. In some of the initial drafts we were working with very early this year, it certainly showed us that it was in the shareholders' best interest to have the management buy those royalties back, particularly when copper prices, start getting up at $4 and beyond, which, we fully expect will happen in the next 10 years.
Okay. Next question. Would you envisage mining Cactus Park Salyer sequentially, or does it make more sense to combine them given that you would need to adjust the permits to include Park Salyer?
Yeah, we've done many iterations of the mine plan. I think we're over 50 at this juncture in time, but the way in which it's falling out at the moment is that certainly the surface stockpile and Cactus West appear to be the first two assets that are mined over the mine's initial 5 to 10 years. And certainly from a risk execution perspective, that makes a lot of sense, because mining a stockpile and doing another pit layback is much easier to execute on, and it's obviously lower cost than going into underground mining. The way the plan sits at the moment is that there's not much mining done on the southeast wall of the open pit. So there is an opportunity very early on in the first 2 to 3 years to actually start driving a decline into Cactus East so that we can access the top of the deposit. That obviously minimizes timelines and development costs, because we're developing out of the bottom of an existing open pit. And then Cactus East would come online essentially in and around year 4 and 5, once the stockpile is beginning to wane. And currently in the plan, what we're envisaging is that Park Salyer would come in a little bit later once Cactus East is actually established. So there is sequential sequencing to the plan in the current PFS, which, as I said, is about 90% complete now.
Great. All right, let's talk about the critical metals sector. Talk to us about the positioning of Arizona Sonoran Copper within that sector. And would there be any opportunities for governmental sponsoring or funding? As I'm sure you remember at Quebec City last June, the Exim Bank announced a big fund, and we've had a few companies that have taken advantage of that since that announcement.
Yeah, that's going to be important for us for sure. I mean, obviously we're producing grade A LME cathode that'll go right into the US domestic supply. We would like that product to go into the green energy sector. So whether that's electrical vehicles or wind turbines or solar panels, etc., etc. In May of this year, my CFO was in Washington to meet with various people from Congress on both sides of the aisle, and then various heads of departments such as the Department of Energy. And of course, in the last several months, the Department of Energy has declared copper as a critical material in the US. My CFO and I are heading back to Washington in a couple of weeks' time to re-meet with those groups. And obviously the strategy at the moment is just to introduce ourselves, get them up to speed on the project. But next year, on the back of the PFS and actually then having declared mineable reserves with a mine plan and a financial and economic model built from mineable reserves, I suspect we'll be making quite a few trips to Washington and these various government departments to try and push for some form of government grant or a low cost of capital loan for the project.
Okay, and in the same vein, how are the current commodity markets impacting you, your share price, the way the markets view the company?
Well, I would say it's certainly impacting, our share price. I don't think we're the only one. I think the junior sector as a whole has really come under a lot of pressure. Everybody's very focused in on the world economy and, slowing GDPs and rising interest rates. So we're just going to have to work our way through it. But, I always take a viewpoint of more of a medium and longer term view. And if you think about metals like copper, which are going to be required to decarbonize, to move off of fossil fuels, to drive the green energy sector, I think the demand in the next 5 years for metals like copper is going to significantly increase, and there aren't many new mines coming online to satisfy that demand. And I think we're going to see continued supply constraints as well. So the copper price, in my opinion, over the next 5 to 10 years is going to have to go much, much higher than what we see today in order to incentivize companies to explore and find new mines or bring on, sub-marginal material that is not profitable today, which companies are just not going to go and mine if we want to meet, the world's, greenhouse gas emissions and various goals with respect to, those targets.
Right, and your mine is very, the capex required to build your mine is very, I'm going to say, reasonable compared to these, billion-dollar structures in, countries in South America, Chile and Argentina and so on. So I think you're really well placed. Yeah.
Yeah, I mean, geopolitically, we're in a very, very safe jurisdiction, and to build a copper mine at that type of production rate for sub $400 million US, assuming we can achieve that, and have it in production within the next 3 years, is an extremely low number, an extremely short time period for bringing a copper mine into production.
Absolutely. All right, so what factors contribute to the claim of being a low carbon mining operation?
Well, we've actually completed what's known as a life cycle analysis on our PEA. We were looking at anywhere between 5 and 8 kilograms of CO2 emission per kilogram of copper produced, which is in the range of what you would find most open pit mines and underground mines. And that was without any remedial actions actually deployed. We then came up with about a dozen action items. And if we implemented all of those, it would take our greenhouse gas emissions down to 1.5 kilograms of CO2 per kilogram of copper produced, which actually would be one of the lowest carbon emitter copper mines in the world. So our plan of action is to redo the life cycle analysis on the pre-feasibility study with mineable reserves, and then see if we can actually incorporate any of those action items into the bankable feasibility study. Because the thing to bear in mind, every one of those action items comes at a financial cost. And first and foremost, we need to ensure that the project actually is project financeable and generates the type of returns that our shareholders are going to want to see. And that's why, before we've sort of gone public, we're waiting for the life cycle analysis on a pre-feasibility study leading up to a bankable feasibility study.
Excellent. And as we're at the top of the hour, we have one more question. And again, this is about the Nuton technology. Is it for oxide use or sulfide only, or both?
The Nuton technology is predominantly for sulfide use. They have tested the technology out on our secondary enriched sulfide, which we ourselves can leach. And they've seen very, very similar recoveries to what the company itself has reported, which is in that sort of 76 to 82% metallurgical recovery. But primarily, the Nuton technology is for the primary chalcopyrite sulfide, which at the moment we have no ability to leach. And normally, you would actually construct a copper flotation mill and produce a concentrate there, which then has to go on for further smelting in order to gain access to that copper. So that's the beauty of the technology, if it is successful, is that it allows you to take advantage of existing heap leach infrastructure will go in place, and obviously a standard SXEW plant with a few modifications with very limited additional capital.
Excellent. So we are at the top of the hour, so we'll be ending the town hall forum shortly. But George, Before we leave, do you have a few words to your shareholders and audience members who've joined us this morning?
Yeah, well, first of all, I'd just like to thank yourself, Joanne, and VID for giving us this opportunity on the platform. I think this is the third town hall we've did, and we found it extremely beneficial for us. So thank you for that.
Thank you.
I'd like to thank everybody for joining us on the call today and showing an interest in the company. I would say keep the faith. This is more of a medium and long-term game. And I believe there's significant value here that's going to be realized, particularly early next year, with a pre-feasibility study that I believe is going to be transformational for the company. And lastly, I'd just like to thank all of the employees of Arizona Sonoran for absolutely knocking it out the park since I joined this company 2.5 years ago. And I would like to, ask them if they could keep up the exceptional work, because they've absolutely delivered on everything that I've expected of them. So keep it up.
Great. Thank you so much, Arizona Sonoran, for joining us today. And should you have any further questions for the company, you may email them directly to Allison at adwaskin@arizonasonoran.com. And just a quick reminder before we sign off to please fill out the quick questionnaire before logging off. This really helps the company and us to communicate more effectively with you in the future. So thanks to everyone who joined us today, and we look forward to seeing you at the next Town Hall Forum. Goodbye, everyone.